Hi, Sam. Congratulations to you and Abigail Sussman on your joint work, which has recently won the Rafi Best Paper Award for ESG-related research. Do investors value sustainability? A natural experiment examining ranking and fund flows. Could you please start by explaining what you mean by sustainability and how investors might think that as a positive or negative attribute?
Absolutely. Well, thank you so much for the award. And so in terms of sustainability, in our paper, what we mean is how Morningstar defines sustainability. And so there's that question. There's also the question about what investors think when they hear something is more sustainable. So we ran a survey as part of the experiment, and we found that most investors think sustainability has something to do with the environment, but there's broad disagreement about other things that it could be related to. People, we found, were quite sure that it meant something, but it meant a lot of things, different things to different people, generally related to the environment. In terms of our paper, what we mean is we look at the impact of Morningstar's sustainability ratings, which is a rating that they developed based on the underlying holdings of mutual funds portfolio.
Okay, thank you. In your paper, you basically examined a natural shock to the salience of sustainability. Can you maybe talk a little bit more about the introduction of the Morningstar ratings and how this might impact the fund flows?
Absolutely. So what we examined was that in March of 2016, Morningstar published a rating system based on how sustainable U.S. mutual funds were. So they were rated from 1 globe to 5 globes in the system. What Morningstar did is they took Sustainalytics scores, then they took the underlying holdings of funds, and they came up with this simple, easy to understand system. And it's a natural shock because all of the information, because all of the information used in the ratings were publicly known before. So they took publicly available information, they put it in this very simple to understand bucket, and we found that basically investors paid attention to this rating and that high sustainability funds received large positive inflows, about 5% of fund size over the next year. Low sustainability funds received big outflows, again about 5% over the next year.
Now we see that mutual funds rated high in sustainability tends to gather more assets. Some people actually think, those aggregate assets tends to influence those individual companies, their cost of capital structure. And this leads into the company will take a different business approach or the economic activities they are conducting. Do you actually consider this channel as important?
So I think it's a broadly important question, and it's one that our paper doesn't directly address. I guess it's a question of magnitude. So eventually, if you're a firm and people stop allowing you to raise capital, this of course might change your behavior. Now in our setting, we're looking at well-diversified mutual funds. My guess is that if they're shifting away from that, there's going to be other sources of capital. So I think this is a hugely important question for the sustainability literature in general. I think it could have an impact, but I think it's ultimately an empirical question as to whether it does so and how much money would have to flow away for it to shift things.
Okay, that comes my next question. You basically documented a roughly $34 billion in flows difference between high sustainability funds and low sustainability funds. It's very statistically significant and big in magnitude, but still it's just a drop in bucket relative to the entire size of the equity market. So do you have an estimate about how large this flow has to be in order to make a meaningful impact?
I wish that I did, and I think that there absolutely is some threshold that it would have an impact both in terms of what firms do and also in terms of returns moving forward. So I think maybe the most relevant data point here would be something like index inclusions. So you join the S&P 500 and you get these big pops in return. That seems to be the fact that lots of investors kind of need to flow in and buy those stocks. I don't necessarily think that we're there yet in the ESG funds. But I do think that we're on pace for continued growth in that area. And we're definitely moving towards magnitudes where it seems plausible that this could both shift around what firms do, how mutual funds perform portfolios, and also if valuations get driven up because of it, possibly returns moving forward.
Another part of the interesting observation from your empirical test is actually the one globe funds, the low-ranking funds, tends to outperform slightly over the high sustainability funds, right? Even though it's over 11 months sample period, perhaps not very significant. But what do you think about it? Do you think it's really a bad sign for the future outlook of ESG investing? Do you think actually investors only care about harvesting superior returns, or they are allocating based on alternative motives?
So I think if you are an investor in ESG, it's important to be clear about why you're investing in it. And so I think there's absolutely investors who view something like an ESG rating as a performance signal. And in our paper, we run an experiment that suggests that at least MBA students and MTurk participants think that high sustainability funds are better investments. And so if you consider high sustainability purely as a performance driver, we'll treat it as performance. Then it's no different from value, it's no different from momentum, and you should treat it as such. Now, if that's where most of these flows are coming from, then I think it does speak to maybe some downside in ESG investing moving forward, because to the extent that the market is mispricing ESG characteristics, the more money comes in, you'd expect that to correct. Now, on the other hand, we also find evidence in our experiment for kind of non-pecuniary motives, more charitable investors in ESG. And so for those investors, a little bit of a kind of performance drag, if they view themselves as receiving enough benefit from their kind of socially responsible investing, well, then it's not the worst thing in the world if there is underperformance by a little bit, because these are investors who might be aware of the fact that they aren't going to perform as well, but this is how they want to spend their money. And so I think the important thing for an investor is to be clear about, okay, why is it that they're choosing ESG outcomes? If it's for the charitable motives, not to conflate that with return-based issues just because it's something that's good doesn't necessarily mean it'll be because of performance. And if it's about performance, you should treat it no different from any other performance driver.
In the past decade, we have observed ESG conversations move forward at pretty rapid pace. Still, ESG belief is very heterogeneous, so there are lots of noises and confusions in the marketplace. Do you have any recommendations for the investors, which ESG aspects actually they should really focus on?
So I'd say for this question, I'm going to focus just on the investors who are doing this for more charitable motives. Because if it's for return predictability, I think you should focus on whatever you believe is kind of an alpha driver or something like that. But in terms of the folks who want more charitable outcomes, I would just say to be clear about what it is that you're buying and to make sure that it achieves the goal that you want. So if you, say, want to reduce carbon emissions or have a specific environmental goal, well then make sure the fund that you're buying, make sure the investment that you're making is doing that. And don't just assume that something with a given name is going for that goal, because a lot of these ratings are fairly broad. They often have characteristics that someone, say, focusing on the environment wouldn't necessarily think about board structure as relevant, or someone who's focused on board structure might not think about carbon emissions. And so whatever your particular goal is, I would say make sure that the metric you're looking at, make sure that the concept that you care about is being addressed, and don't assume that that's just the case.
Okay, thank you, Sam. I think we have covered lots of aspects of your research. Would you like to give a quick summary of the key takeaways?
Sure. So I'd say the key takeaways of my paper is that Morningstar published these sustainability ratings, that there were large inflows based on them, and that means that the market overall values sustainability, that mutual fund investors in the US, think that this is a good characteristic on net, because with fund flows, you have both people moving into funds and out, so on net, the market viewed these as a positive thing. We examined a variety of different explanations of what investors cared about, why it was that we saw these flows. And I'd say we found evidence that suggested it's not purely institutional, that we do not find evidence of outperformance, which is what you'd expect under kind of a rational explanation of these flows, but we were looking at 11 months of data, so it's very difficult to say anything definitive. And that when we ran our experiment, we found evidence both of people viewing these as performance drivers. They thought that high sustainability funds would have higher performance and lower risk, and also of charitable motives. It looked like people allocated more money in our experiments to high sustainability funds than could be explained purely by performance metrics.
Thank you very much.